Hey, everybody. Thanks for being here. Look at how we spent our summer. We're going to start with presidential cycles. We're going to revisit those again. I hear a lot of sell in May didn't work this year. Well, sell in May is not over until Halloween. So let's keep that in mind as well. So we'll look at some reasons why you don't want to think that part of the season is not over yet. So keep that in mind. We're going to look at the regular seasonality again with the past 10 years and compare that to the first year of a presidential cycle, because that's some interesting contrasts and things that we're seeing. Little hints of both are starting to play out. So that's been a fun thing that we've been looking at this summer. We're going to look at our current money flow stats and then one new stat that we added in our newsletter the end of last month, and talk about that a little bit more in depth. Let's start. This is the first year of a new president over the past 25 years. So that is 7 presidents and the average of what the S&P typically did when that market happened. So typically, this has been following surprisingly well. We had a big, ugly February, March. Actually, the fall was a little bit later in here, and then April was bad, but a big dip and then a rebound and then a little iffy and then a rebound. And then here where we are now, the expectation is from here to Halloween is not the best time of the year. This is actually the worst 3 months of the year to be invested. And there are stats showing that if you were just not invested from this period, it doesn't really hurt that much. And in some cases it helps, but you never know. This time it's different. It could be. You never know what's going to happen there. In the presidential cycle, usually we peaked first week of August, right around where we are now. The market has been drifting down, and we've been mirroring this a little bit. So I'm curious if we see a continued sell-off into August and then it finishing out in September before rallying, or if we look at the past 10 years, we get the sell-off in the beginning of August, just like we see now, just like the previous chart. But we get a rally into mid-month, somewhere in the 16th, 17th range, and then we get the whole drop happening in September. Now that's an interesting, what if, but if these are things that we try to keep an eye on and say, what is the market doing? What's the data telling us? Which are the next charts I'll show you. And if those start saying, hey, there's a problem, then we're like, okay, seasonally, this is not the best time to be invested. So we'll use that as a way to get out and be a little more defensive. So on to that data. As of right now, the advanced decline is above the 21. I really care mostly about the 55, which is this dark blue line is as long up there. It's in a pretty good shape. It's a pretty good spot. And we're above the 21, which is even a shorter term time frame. And that's been steady. So you really can't complain. Money is coming into this market. And it really did finish off right around the end of April when the market did bottom. We had the temper tantrum and then a couple of sell-offs and a little messiness. And then it really did take off. And it's been somewhat stable since then, surprisingly. Certainly not what I would have expected with the conversations I had and the news we saw in late March and April with around the tariffs, but it just doesn't seem to matter anymore. Our money flow factor, it's weak but improving. I don't know if this is going to hold. This last one had a bit of a failure. Like it was well off the lows and then just kind of rolled over a bit. And then now we've got another one, and I'm not really impressed with how strong the market is. I want to see that money flow certainly come back above this 200 line. If it can push up into here, we might have time for a rally. The next things I'm going to show you kind of suggests why I don't think it's going to happen just yet, at least not for another week, maybe or two. So we'll see how that plays out. Major indexes right now, Japan and China are the top 2 major ones, but everything on MACDs, MACDs are negative over here. So most indexes have started to roll over. The T8 is a short-term 8-day trend line. While they're holding that, this will break first and then that will happen and it just kind of cascades down into negativity. Now the worst 2 are the Dow and midcap. Dow here, midcap there. Midcap actually has a confirmed downtrend right now, so that's not super positive. Though midcap and small cap are really completely disconnected from this market at this point. And they have been for a while. They just do their own thing and they really don't do much. So diversifying into those, as I see, some other people like to do, doesn't help. Same with a lot of the bond market. It doesn't really help. So always just keep in mind where these things are. I actually think EFA has some interesting underlying strength that we could see. If I were to buy something next, it may be in that area. It's too early to tell, but that's just an interesting heads up that I'm seeing. And again, I hope these can stay strong, the S&P, NASDAQ, etc., but it's too hard to say. Looking at the sectors, they're all starting to push over to the negative side. And if the S&P sectors move to the negative side, that means the S&P is going to in turn fall with them. It's the sum of the parts. That's why I like to look at it this way, because then get an understanding for what the index is doing rather than just saying, oh, it's up, it's down. Why? You can start to see internally what the multiple parts are trying to do inside of the index. So right now, what's the strong one? Positive above. We've got the XLP that's defensive, that is consumer Staples, that does well when the market's bad. And the other big one here, positive on the MACD with everything else is negative, is utilities. So when you have those two leading, that's not the most positive situation for the market. You really want to see the tech leading, you want to see XLC leading, you want to see financials, etc. Those things pushed at the top of that list but they're not there. And we're seeing things move over to the negative side. So I'm not super strong on this market for the next little bit. And I think the seasonality, it backs it up. It's not a time to be super aggressive. We have been trimming a little bit here and there. If we had some good profits on things, we'd bring it back to the allocation if the allocation grew. So we've been taking little profits, but nothing too aggressive yet. We're not in a falling market yet. We're not in a time where we have to really get defensive. Just kind of keep an eye on things, make sure it's okay, take profits here and there. That's the mode we're in right now. If you look at the RRGs, watching the ducks go around the pond, this is not what you want to see if you want to be too aggressive. You certainly don't want to be putting new money to work here as we're in the weakening box, pushing into the lagging. And it's taken a while to come down here. I think last time we were up here, it came into the yellow, peaked back up a bit, and now we're pushing back down to the left with most sectors, and that's not really positive. But what I love is when you get a big grouping like that looks like this, somewhere in here, that's a beautiful time to get very aggressive, push into improving. Now, it can be a little bumpy getting out of there, but that's a really good spot. Last time we saw a really good grouping was in April after the tariff tantrum. So this can set us up for a very good run. I just don't know how soon that could be. It could be a week, it could be a month. You just don't know. Right now, you don't get real excited about this. The XLB healthcare is trying to go positive, but it's just not looking great. Same with energy, trying to, but it really isn't doing much. And then utilities while they're leading, they're about to fall into weakening, and that's just not a good sign either. And then finally, my new favorite toy from this summer. I've been following a lady named Bonnie Gortler, and she worked with Gerald Appel, and he was the guy that created the MACD calculation, the MACD calculation. And I thought that was really cool. And one of the things that she also likes is looking at the new lows only, separated out on the NYSE. The way that she looks at it is if the 50 line, I've got this green line. I also have this inverted, so, down is up. But above this green, we have less than 50 stocks on the NYSE hitting new lows, right? So that means there's really not a lot of fear in the market. When it peaks down into this red, we're starting to get to 100 new lows. And then when you get like the taper tantrum, when the market's really getting afraid, you'll see a lot of new lows. This was like 1,200 we almost saw, and then it rebounded. Where this got really interesting in the hindsight, which I wish I were using it more, and I will in the future, here was the first big drop in the market, and then the next couple subsequent drops, the new lows were not getting worse. And that's really interesting. It's a tell that says, the market's not as bad underneath as what the news is saying, or what the vibe you're seeing out there in the indexes. You may see something turn around more sooner than later is what's likely to happen. So I think this is a really good indication of how bad things are internally. And you go back and look at other years that were bad, is when this breaks and stays below, then yeah, you've got a problem. But then a push back above this red, and then even in the green, this is just like smooth sailing. You don't really worry too much about it. And that backs up the other data that I showed you earlier. So that's what I got. That's what we worked on this summer. Thank you so much.